the KingCast, as always presented by the King Economics Division of the Social Science Department. I'm your host, Frank Roach, and I'm solo today. The team is down with the flu, so I'm going to take this on my own. We've changed our format a little bit this year. Now we're covering the monthly economic report, and for this KingCast, we're covering November. What's going on in the U.S. economy? How are things performing? We'll check on economic growth, inflation, the labor market, monetary policy, fiscal policy, check on some financial markets, get you caught up for the month. A lot of activity. We can't cover it all, but we cover the highlights. We started a discussion of the monthly economic report with growth. Our best measure of growth is GDP, gross domestic product. This is a quarterly number released 4 times a year, but revised 3 times per quarter, so we get a GDP print every single month. We're covering November, the second month in the fourth quarter, and we're touching on Q3 GDP. So this is now the second look at Q3 GDP. We call this the preliminary report. In October, the first month of the fourth quarter, we had the advanced report, and in December, we'll get the final report. And each time, the government collects more information and adjusts the number accordingly. And for the month of November, with our GDP release, we had an upward revision of real gross domestic product from 2.6% to 2.9%. Again, the second estimate. I remind you that the first quarter GDP was down 2.6%, and second quarter GDP was down 0.6%. So the average, we're bumping along 0.14-ish% growth for the year, so very close to recession. We expect Q4 GDP to be no stronger than Q3 and possibly a move back towards recessionary levels. Remember, we just define a recession as 2 consecutive quarters of negative GDP growth. I know there was an effort to change that definition over the summer in the face of the midterm elections, but that is the accurate definition. So the second estimate, the revision upward, primarily reflected upward revisions to consumer spending and non-residential fixed investment that were partly offset by a downward revision in private inventory investment. The increase in real GDP reflected increases in exports, consumer spending, non-residential fixed investment, state and local government spending, and federal government spending that were partly offset by decreases in residential fixed investment and private inventory investment. Current dollar personal income increased $291.3 billion in the third quarter, an upward revision of $0.1 billion from the advanced estimate in October. The increase primarily reflected increase in compensation led by private wages and personal interest income as interest rates rose over the period. Disposable income, income after taxes, increased $235.8 billion or 5.2%, a downward revision of $32.6 billion from the previous estimate. Of course, we can all think about taxes. We can think about real incomes, and real incomes have been falling dramatically, of course, for most Americans as inflation far outpaces wage increases. Real disposable personal income increased 0.9%, a downward revision of 0.8 percentage points, again, adjusted for inflation. Personal savings was $520.6 billion in the third quarter, not bad, but a downward revision from $67.6 billion from the previous estimate. And the personal savings rate, an important measure for any economy, it's about putting off instant gratification and saving for the future. Personal savings as a percentage of disposable income was 2.8% in the third quarter, a downward revision of 0.5 percentage points. 2.8% is very low. We can identify savings as national savings and private savings. And private savings are made up of business savings and household savings, or the personal savings rate. We know government savings is negative to the tune of $1.3 trillion a year with $31 trillion in debt. Business savings is always quite strong, and household savings remains weak in the face of rising inflationary pressures in a recessionary economy. So labor market's doing okay. The growth is doing okay. We expect more recessionary pressures coming into the first quarter of 2023. The Fed will continue raising interest rates up to 5%. That will reduce aggregate demand in an effort to bring down inflation. And of course, that moves us towards recessionary pressures. Let's turn now for a moment to the labor market. This past Friday, the 2nd of December, was the release of the most important data point in the whole world, the employment situation report. That gives an insight into the health of the U.S. labor market. The U.S. economy being the largest economy on the planet, it's very important for all investors and buyers and sellers of goods and services across the planet. So we have the employment situation report released on Friday, and we get from that report non-farm payrolls and net change in job growth, average hourly earnings, the average work week, and then we get two unemployment rates. The U3 rate, the narrowest measure of unemployment that you see in the newspapers and on internet news sites, and the U6 rate, the broadest measure of unemployment, which is the most appropriate measure to look at. And this measure includes discouraged workers, those people who have given up looking for work because they simply can't find a job. So for the month of November, total non-farm employment increased by 263,000, and the unemployment rate, the U3 rate, was unchanged at 3.7%. The U6 rate ticked up to 6.7%, although close to what it was in October. Notable job gains occurred in leisure and hospitality, healthcare, and government. Typically not very high-paying jobs, and a lot of those jobs are part-time. Employment declined in retail, trade, in transportation, and warehousing. As we reduce economic output, as we reduce aggregate demand by raising interest rates. Transportation and deliveries are some of the earliest sectors hit. The unemployment rate, again, U3, was unchanged at 3.7%, and it's been in a narrow range of 3.5% to 3.7% since March. A good number to be sure, and the unemployment rate is the number of unemployed workers divided by the labor force, and so you can fuss with that number by changing either the numerator or the denominator. The number of persons unemployed was essentially unchanged at 6 million in November. Among the major worker groups, the unemployment rates for adult men was 3.4%, adult women 3.3%, teenagers 11.3%, whites 3.2%, blacks 5.7%, Asians 2.7%, and Hispanics 3.9%. And those all showed little change over the month. In November, average hourly earnings for all employees on private non-farm payrolls rose by 18 cents or 0.6% to $32.82. Over the past 12 months, average hourly earnings have increased by 5.1%. Now, if you're a worker, obviously you love those numbers, you want higher wages. But of course, this is highly inflationary. Employment labor costs usually account for about 60% of a business costs. And so as wages rise, whether we deserve them or not, it is inflationary. In November, the average work week for all employees in private non-farm payrolls declined by 0.1 hours to 34.4 hours. Remember now, this number has been stuck below 35 hours for a long time. Go back to 2010. The passage of the Affordable Care Act, aka Obamacare, which incentivized employers to reduce full-time employment to reduce their responsibility for healthcare services. Both the labor participation rate at 62.1% and the employment population ratio at 59.9% were little changed in November and have shown little change since early this year. And these numbers are at recent 10 to 15 years lows. All right, so let's look at the labor market from the job perspective and the job growth perspective. Let's look at it a little bit differently from the initial unemployment claims perspective. This is a weekly number we get. Initial unemployment claims comes up every Thursday at 8:30 a.m. and shows the number of Americans who lost their job in the prior week and filed for initial unemployment insurance. For the week ending November 26, the seasonally adjusted initial claims was 225,000, a decrease of 16,000 from the previous week's level. The previous week's level was revised up by 1,000 to 241,000. And the 4-week moving average was 228,750 people, an increase of 1,750 from the previous week's raised average. As the Fed raises rates to reduce aggregate demand to bring out inflation, the economy slows, output falls, and unemployment rises. And of course, the first indication of unemployment are the initial unemployment claims. The previous week's average was revised by 250 from 226,750 to 227. For the rest of the month, for the week ending November 19, claims were up 240,000. For the week ending November 12, claims were up 222,000. And for the week ending November 5th, claims were 225,000. The monthly average was 228,000, and this is a good number. These are numbers of a normal economy and a near full employment level. It indicates that layoffs are very low still, although we've had huge announcements, mostly from the tech sector and big corporations, of coming layoffs. They haven't shown up in the claims data yet because, of course, today most layoffs come with significant severance packages and some compensation before filing for initial unemployment claims. So good numbers, but we do have a dichotomy developing in the labor market. We are still well below the total number of employed today compared to January of 2020 before we went into COVID lockdown. So we still haven't recovered fully in terms of numbers of jobs. And we're having a divergence, like dichotomy developing between the establishment survey of the employment situation report and the household survey. The household survey is a telephone survey done via households and gets us an unemployment rate. And the establishment survey, of course, is calculated through the establishment hiring and firing. And we have a unique dichotomy developing where we're seeing significant job growth in the establishment survey, but no indication of the same in the household survey. Now, this may be as a result of a weakening economy and people moving out of full-time jobs and into multiple part-time jobs. Remember, part-time workers are included in the employment situation report as full-time workers. It'll take a couple more reports to determine if this dichotomy is something real, if data is being manipulated for the benefit of some. We'll have to wait and see, but this dichotomy is getting economists' attention and something that we'll pay attention to in the coming reports. All right, so we've covered growth, we've covered labor. Now let's check in on inflation and the price level, which is on the minds of most Americans today as real incomes drop and food and energy prices remain highly elevated. We look at the CPI, the Consumer Price Index, the PPI, the Producer Price Index, and the PCE deflator, the Personal Consumption Expenditure Deflator, which is the favorite of the Federal Reserve. That comes from our GDP series. For the CPI, the Consumer Price Index rose 0.4% in October on a seasonally adjusted basis, year over year of 7.7%, still at levels we haven't seen since the 1970s. The index for shelter contributed over half of the monthly all items increase, with indexes for gasoline and food also increasing. The energy index increased 1.8% over the month, as the gasoline index and electricity index rose, but the natural gas index decreased. Energy prices are up almost 70% since the start of last year. This is a result of too much money chasing too few goods, instigated by the Biden administration, the Federal Reserve, and of course, we can't forget Russia's invasion of Ukraine as a primary mover as well. Excuse me. Indigestion on camera, always uncomfortable. Anyway, let's move past that. The food index increased 0.6% for the month, with food at home index rising 0.4%, following a 0.8% increase in September. And boy, oh boy, I just got my shopping done today, and I can attest to that. The food at home index rose 0.4% in October, the smallest monthly increase in the index since December of 2021. So inflation is still rising, but the second derivative is negative. So prices are rising at a lower rate, so increasing at a decreasing rate, which is good news to be sure. There will still take some time for the price level to fall, as long as the Fed keeps raising rates and aggregate demand begins to wane. The energy index increased 1.8% in October after falling in preceding 3 months. The gasoline index was up 4% over the month, following 3 consecutive declines. We're moving into a seasonal period where we use lots more energy, so there's seasonal adjustments here. The energy index is up 17.6% over the past 12 months. The gasoline index up 17.5%, and the fuel index up 68.5%. Ouch. The food at home index rose 12.4% over the last 12 months, and indexes for cereals and bakery products were up 15.9% over the year, and the index for dairy and related products was up 15.5%. For all you bakers out there, Miss Gigante in her club, that's got to be hurting the budget when it comes to baking. And of course, as we come into the Christmas season, that'll be heavily impacted as well. All right, so that's the consumer side. The producer side isn't a lot different. Producer price index was up 0.2%, and 60% of that increase was related to demands attributable to gasoline and food. Again, huge increases in wholesale prices at the food and energy level as a result of variables we've already talked about. Prices of diesel fuel, a very important fuel for our delivery system across America, fresh and dry vegetables, residential electric power, chicken eggs, and oil field and gas field machinery also advanced. And for the year, the PPI is up 8.2%, led by energy and food. Not good news. And again, the only real correction here, the only way to solve this is to reduce demand, to reduce output, to move the economy into lower levels of economic output, which may mean recession, of course. It's a horrible trade-off. Remember, the Fed's dual mandate is stable prices, inflation around 2%, and full employment, which means unemployment around 4%. And again, I mentioned this dichotomy. We have very low unemployment, and yet we have these high levels of prices as we move into recessionary kind of environments. All right, let's check in on the GDP series, the PCE, the favorite of the Fed. The price index for gross domestic purchases increased 4.7% in the third quarter, an upward revision of 0.1% from the previous estimate in October, the advanced estimate. The PCE price index, the personal consumption expenditures, increased 4.3%, and that was a revision up of 0.1%. Excluding food and energy, the PCE increased 4.6%, and that was also revised higher. Why the food and energy? Well, food and energy prices are highly volatile. Food and energy prices are found on international financial markets, largely driven by speculation, also supply and demand imbalances, but largely driven by speculation. And so we take those numbers out to get an underlying look at inflation without those volatile numbers. We can see them all still, but we just want to have a look at that as well. All right, let's take a look at the trade side of the U.S. economy. Remember our trade deficit, which we've been running since 1974-ish, when we began to open up to China and Asia, is now going to find a new record in 2022. Will be almost $1 trillion in trade deficit for the year 2022, driven by imports of goods. Really bad sign for economy. When we think of our GDP calculation, C plus I plus G plus X minus M. That last factor, X minus M, is a negative, and of course makes our GDP lower. Some economists argue that while that X minus M number falls and reduces GDP, that the benefit is cheap goods that pushes up consumption, which puts back some strength in GDP. That's a debatable point. It's raging constantly. But the international trade deficit for goods was $99 billion in October, up $7.1 billion from September. Really bad news. A new record on a month. That's $99 billion we've sent from our economy to overseas nations that we will not benefit from. Exports of goods for October were $173.7 billion, down $4.7 billion from September. And imports were $272.7 billion, up $2.4 billion compared to September. Now, of course, the country with whom we have our largest trade deficit, about 40% of our trade deficit is with one country, China. That's driven by one thing, well, actually two things: very cheap labor and a desire by U.S. multinational corporations to take advantage of the 1 billion consumers China has within its borders. And the Chinese are very smart about this. If you want to sell to our consumers, then you have to manufacture in our economy. And of course, they manufacture low-wage goods in China. They export them back to the U.S., and such is our trade deficit, which has huge impacts on the labor market as well. All right, checking on monetary policy. As we know, the Fed has been raising rates for some time now. The last 4 meetings, the Fed has increased the federal funds rate, the overnight rate banks use to borrow and lend from each other to maintain their Federal Reserve requirements on a daily basis. And the federal funds rate is an overnight rate. And right now that rate is at 4%. It was at 0 not that long ago, several months ago. The Fed has been raising rates 75 basis points at a time. And so we had Fed Chair Jerome Powell out this past week on Wednesday, giving a speech about monetary policy. I want to share some of that speech with you now. High inflation is imposing significant hardship, straining budgets and shrinking what paychecks will buy. That's the drop in real income. This is especially painful for those least able to meet the higher costs of essentials like food, housing, and transportation. So think the middle class and lower. Above a certain income level, these things simply don't matter. Price stability is the responsibility of the Federal Reserve and serves as the bedrock for our economy. That's about price stability and inflation expectations. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. The Fed estimates that 12-month personal consumption expenditures inflation through October ran at about 6% year over year, which is still very elevated. While October inflation data received so far showed a welcome surprise to the downside, these are a single month's data, which followed upside surprises over the prior 2 months. Tightening the stance of policy in order to slow aggregate growth and demand is the key task of the Fed presently. Slowing demand growth would allow supply to catch up with demand and restore the balance that would yield stable prices over time. Restoring that balance is likely to require a sustained period of below trend growth. Again, raise rates, reduce aggregate demand. In the labor market, demand for workers far exceeds the supply of available workers, and nominal wages have been growing at a pace well above what we consistent with 2% inflation over time. Again, we've seen wages rising 7-8%. Thus, another condition we are looking for is the restoration of balance between supply and demand in the labor market. Signs of elevated labor market tightness emerged suddenly in mid-2021. The unemployment rate at the time was a much higher than 3.5% that had prevailed without major signs of tightness before the pandemic. Employment was still millions below its level at the eve of the pandemic. That's talking about October, of course, which I referenced a little bit earlier. Looking back, the Fed says that they can see a significant and persistent labor supply shortfall opening up during the pandemic, a shortfall that appears unlikely to fully close anytime soon. This is a new trend of quiet quitting or laying down amongst younger workers who don't like the wages they're being offered, so they're choosing not to work. And of course, that was motivated by the very overly generous unemployment compensation and payroll protection programs that were offered by the Biden administration. Growth in economic activity has slowed to well below its longer run trend, and this needs to be sustained. Bottlenecks in goods production are easing, and goods prices inflation appears to be easing as well, and this too must continue. Housing services inflation will probably keep rising well into next year, but if inflation on new leases continues to fall, we will likely see housing services inflation begin to fall next year. Finally, the labor market, which is especially important for inflation in core services excluding housing, shows only tentative signs of rebalancing, and wage growth remains well above levels that would be consistent with 2% inflation over time. Despite some promising developments, we have a long way to go in restoring price stability. Those were comments by Fed Chair Jerome Powell. Now, financial markets took that as a sign that the Fed is going to lift its foot off the pedal a little bit and rallied. Stock markets rallied on the end of last week, Wednesday, Thursday, Friday. Really surprising to see that reaction because the Fed only said they're going to reduce the pace at which they increase rates, not that they're going to stop increasing rates. Their target is still 5%. Whether they get there in 1 or 2 rate hikes or 3 or 4 shouldn't make a difference, but nonetheless, Jerome Powell did say 75 basis point hikes are off the table for now, so we're looking for interest rate hikes of 50% or 25% over the coming few months as the Fed moves from a federal funds rate of 4% to 5%, which is a normalized federal funds rate. If you're a KingCast listener for the past 4 years, you will have heard me say many, many times the Fed must normalize the federal funds rate, and we're finally at a point where we're near normal. Just a few more rate hikes and we'll be there. Now speculation is developing that as a result of these rate hikes, the economy will move into recession in 2023, and by the end of 2023, the Fed will be cutting rates again. Remember now, the smart money, financial market participants that are there on a daily basis, discount this new information way before retail traders, retail investors. And so they're already looking ahead 12 months in terms of pricing equities, bonds, currencies, and commodities. All right, let's turn to fiscal policy, which remains an absolute mess. For the 13th out of the 14th past years, Congress, presently led by Nancy Pelosi and Chuck Schumer and Joe Biden, have failed again to come up with a budget as constitutionally is required of them. Fiscal year 2022 ended September 31st, and fiscal year 2023 began October 1st, and we still do not have a budget in place, and it's December 4th. This has been happening every year as members of Congress fail in their responsibility because they're not focused on their job. They're busy raising money. They're focused on re-election, cultural things, social things, and not the actual work of the government. It's a national embarrassment for us that this continues, and it's highly inefficient in no way to run the largest economy on the planet. So for 2022 federal fiscal year, it began October 1st. Congress has yet to pass a budget. So we continue to move on a continuing resolution. That is to say, a continuing resolution is voted in place to allow whatever spending was in place to continue to be in place. And of course, the government recognizing they were not going to, well, Nancy Pelosi and Chuck Schumer recognizing they were not going to get a budget done on time, passed a continuing resolution in September that expires December 16th. And they were supposed to have come to agreement for a budget by December 16th. And of course, they're failing at that as well. So this scenario has become very common now. Every December, there's a fit of political activity in Congress as they push back and forth between Democrats and Republicans trying to come together with a budget. There will be a debate about the debt ceiling, which of course will be automatically moved higher because no one has the backbone to cut spending in Congress. And the debt ceiling will rise again. They'll pass another continuing resolution. And the $1.3 trillion deficit for fiscal year 2022 will be repeated in 2023, where we see estimates for another $1 trillion budget deficit. $1 trillion budget deficits are just a normal thing now in Washington. And I remind you, this will take our national debt up to $32 trillion by the end of 2023. Really scary. Again, I indicated Congress faces a December 16th deadline to strike a deal on full-year funding, but is widely expected to pass a short-term funding patch to continue negotiations. So they might pass a CR, a continuing resolution, till early January, and then try again to put something together. After the short-term patch runs out, a year-long continuing resolution is a possibility if appropriators can't agree on the long-term spending bill. The long-term spending bill simply means the yearly budget as required by the U.S. Constitution. This past week, House Speaker Nancy Pelosi said a full-year continuing resolution is possible, calling it a last resort. Just horrible, just failures of their responsibility. They get paid $175,000 a year. They are engaged in all kinds of insider trading. They have all kinds of perks, and they can't do their job. It's really embarrassing. And I believe Nancy Pelosi still has a remote working environment going in the House where they don't have to show up in the Capitol to do their work. They can work from home. Top Democrats and Republicans at Capitol Hill have said they want to finalize a package to fund the federal government in the final weeks of the congressional session this month, rather than punt it to next year, when a divided Congress might not be able to forge an agreement. We're a divided nation. We know this. It's a 50-50 House, almost a 50-50 Senate, almost a 50-50 House, and that makes these negotiations difficult. One side wants to cut spending, one side wants to increase spending, and of course, those who pay are you and I as U.S. citizens. Remember, the Fed has a contractionary monetary policy in place to reduce inflation. The fiscal side, run by Joe Biden, Nancy Pelosi, and Chuck Schumer, on an expansionary fiscal policy. And so those two counteract and are not helpful for anyone and are not going to help in terms of reducing inflation. So those are the big broad strokes of the story of the November economic report. We'll check in just a little bit on financial markets to see how they performed over the month. I always get a lot of questions from my friends and relatives and clients who have 401ks and pension plans. When markets are going down, they're calling me and texting me and talking to me constantly about what to do. And then when markets are going back up, it's dead quiet. I think that's hilarious. And of course, markets are back up on speculation that the Fed is going to slow the rate hikes and that eventually we'll have to cut rates to stave off recession in the second half of 2023. So we'll check on the stock market. We use as our proxy for the stock market, the S&P 500. Opened the month at 4,003, had a high in the month of 4,098, had a low of the month at 3,938, and closed the month at 4,076, up 73 points on the month. Not bad for an economy that's really struggling. On the fixed income side, thinking about bonds and the U.S. yield curve, we use our proxy, the 10-year U.S. Treasury, the benchmark bond. Opened the month at 3.68%, had a high of 3.79%, a low of 3.51%. Closed the month at 3.49%, down 19 basis points. The 10-year Treasury is below the one-year note. We have an inversion in the yield curve as we expect inflationary pressures and higher rates in the near term and lower rates in the future. And so we have this inversion in the yield curve, which usually signals recession. Checking in at foreign exchange, we'll use the US dollar index as our proxy. Dollar a little weak on the month. Index opened the month at 106.22. Had a high of 107.10, a low of 104.49, closed the month at 104.51, down 170 points on the index, indicating a weaker dollar against most of the major currencies. Weaker dollar is what we want here in America. It's the only way for us to help us correct our trade deficit. As the dollar depreciates against other currencies, especially the Chinese yuan, our exports become less expensive, and imports become more expensive, and in that way we can reverse our trade balance deficit. All right, lastly, check on commodities. There's so many commodities to look at. Of course, we think of food and energy, oil, gas as the main things to focus on. We have gold, we have wheat, we have live cattle, feeder cattle, lean hogs, all kinds of things to look at. So we'll just look at the index, the commodities index as presented by Bloomberg. The index opened the month at 113.61, had a high of 117.58, had a low of 113.61, which is the open of the month, and closed at 114.47. So prices continue to be higher at the wholesale level, led by food and energy. We can see this, of course, at the gas station when we get our heating bills at home and we go to the grocery market each week. Not to mention, have you noticed food prices at restaurants? Oh my goodness, going to the roof. And you've noticed what else restaurants are doing? Not only are their prices higher for their menu items, now they're tacking on the merchant fees that they are charged for the use of Visa and Amex cards. Now they're making it part of our bill. For most of the past 70 years, those fees were hidden within their prices. And now I assume they're taking a double dip on those fees, having in both their prices and then charging us additionally on the bill. Really bad policy. And we should pay attention to that as consumers and push back on that. All right, that's a broad stroke look at the U.S. economy for the month of November. Remember, we're always backward looking, right? From talking about November, that data is usually related to October or the third quarter. We don't get much data in real time, so that's just how the calendar operates. The U.S. economy is bumping along near recession. Labor market remains strong, but something is showing up that suggests that might be a bit fugazi. It might be about part-time work. Wages are rising, but still below the rates of inflation, so real incomes are dropping. Fed's going to continue to tighten rates. It's a mess in Washington, D.C., and should be more of a mess in 2023 as Republicans take control of the House and we remain with a basically 50-50 Senate. So with that joyous news, let's check in our friendly reminders before we head out of here. Don't forget to do your reading, kids. Do your homework. It's one of your important touches. Come to class prepared to focus and engage. And for all you driving at school, this includes the adults, of course, use your blinker when making turns or switching lanes. It's the law. Stop signs mean stop. Your wheels actually have to come to a stop. No texting while driving. You're going to kill yourself if you do that. And always try to buy American. All right? It's hard to do these days, but give it a shot. It'll help your fellow countrymen. That's it for us. Join us again next week. And tell your friends and family to listen to the KingCast at kingschoolct.org. Academics, upper school, clubs, and activities. Have a great week.